Hi there. Welcome to the Value Investing Fundamentals course, brought to you by Wealthy Education. In this course, I'll teach you how to get started in value investing fast. You'll learn exactly what you'll need to do when evaluating a company and what you'll need to look for when picking a stock to invest in. So if you're just starting out or you're looking to learn value investing fast so you can start growing your retirement funds or portfolio more quickly, this is the course for you. Here's exactly what you'll learn in this course. In this course, we'll provide you with a strong value investing foundation. I'll teach you 3 easy, simple steps that you can follow to find and invest profitably in value stocks. You'll learn exactly how to assess a company by looking at 3 different types of value. This is critical because most investors only look at 1 or hopefully 2 when evaluating a company that they want to invest in. And that's why they end up buying a cheap stock at a much higher price. You'll also learn how to use a margin of safety to significantly reduce risks on your investments and correct all the mistakes you might make in your valuation process. I'll also teach you 7 golden value investing principles that every stock investor should live by. And in the last module, we'll also talk about 5 different things you can follow to identify if a company has a sustainable competitive advantage, so it can compete with other companies within the same industry. And we'll also make a complete value investing roadmap for you so you know exactly what you need to do now and what you'll need to do next. You'll know exactly your next steps and what you'll need to learn to become a successful value investor. So, if you're looking for a crash course on value investing and how to get into the exciting world of value investing in a profitable manner, I'd like to invite you to join us. Sign up for this course today. Hey guys, welcome to Module 1. In this module, I'll help you understand quickly how the value investing strategy works in the real world. We'll dive into what exactly value investing is, how it works, and I'll show you 3 simple steps to implement this strategy so that you can profit from the stock market and grow your money. Okay, now let's get started. So what exactly is value investing? Value investing is simply an investment strategy where stocks are selected that trade for less than their intrinsic value. So, what does that mean? Intrinsic value here is a real or true value of a company. By doing value investing, you simply invest in stocks that are currently undervalued or become temporarily cheap. Value investing is driven by the idea that there are ways to benefit financially from the events that cause stock market prices to swing up and down. So when there are rumors or bad news about a company, its stock price will drop. And as a value investor, you simply take advantage of these events and buy the company's stock at a much lower price. On one level, a stock's value is reflected in its current market price. Since the market price indicates how much investors are willing to pay for a stock at any given time, it indicates the stock's market value. But the key point to note in value investing is that a stock's market value is not the same thing as its fundamental or intrinsic value. Sometimes businesses can become temporarily popular or unpopular for a variety of reasons that have little to do with the true worth of their revenues, net assets, or their future income potential. So, as a value investor, our job is to find a company's true value and compare it with the current market price, so we can determine if the stock is worth buying or not. When a company's stock is undervalued, it means that it's selling at a price well below the value of its current and predicted cash flows. For example, a stock is selling at $3.21 a share, and you find that it's actually worth $5.67 a share. So this simply means this stock is undervalued, and it's a good buying opportunity because you know that the stock price will likely go up in the near future. So you simply buy low at $3.21 a share and then sell high at $5.67 a share, for example. In this case, you can make around $2.50 a share in profit. At the same time, a stock that's overvalued is one that's selling at an inflated price, well beyond its true value or its predicted cash flows. For example, you find a stock that's selling at $5.67 a share, and after applying some valuation techniques, you know that this stock is only worth $3.21 a share. So this means it's overvalued, or expensive to buy. There are chances that its price will drop in the near future, so we simply sell it or avoid buying it. You see, value investing can tell you exactly whether or not a stock is a worthwhile investment. With this information, you can easily profit from the stock market. So what is the smartest strategy for buying and selling stocks? As a value investor, we'll buy on bad news and sell on good news. Do you know why? Well, most investors will do the opposite. They buy on good news and sell on bad news. You know, that's risky because they can easily buy an overvalued stock which likely drops in value. For playing safe with the stock market, why don't we wait until there are some rumors or bad news? These events will likely cause the stock price to drop temporarily, and the stock can easily become undervalued. And then we can buy low and sell high for making an easy profit. And similarly, we'll sell on good news because chances are the stock price will surge temporarily during these events and sometimes become overvalued. We simply sell at a high price and take the profit. So here's a quick tip. If an undervalued company is financially strong with a solid profit history and promising future earnings, its market price is very likely to rebound after a temporary downswing caused by investor fear or disfavor. This means solid companies with efficient operations and strong financial performance are always winners. We don't care when their stock price drops because of bad news or rumors. Their financial performance proves that they can survive market downturns, and their market values will likely go back up and reach closer to their intrinsic values. So, to be a profitable value investor, all you need to do is find companies with a strong fundamental performance. In the next lecture, I'll teach you how to implement the value investing strategy. In this video, we'll talk about 3 easy, simple steps that you can follow to invest in a value stock. The best value investing strategy starts with learning to identify fundamentally strong companies. If you attempt to profit by buying stocks that have simply dropped in price without first ensuring that they have the underlying ability to eventually recover, there's a good chance you'll experience some financial loss instead. An effective value investing formula dictates that we must first look for strong businesses, buy when their stock is undervalued, and sell when it rebounds or becomes overvalued. Now, let's dive into each step so you can understand clearly what to do and how you can profit by investing in undervalued stocks. Value companies are not named for their positive market values, since every company's stock price fluctuates on a regular basis in conjunction with individual news events or occurrences within the market as a whole. A fundamentally strong business is known as a value company because it possesses actual inherent worth in terms of its consistent earnings, dividends, and cash flows. So, you want to make sure you'll only invest in companies with a consistent growth in earnings, dividends, and cash flows. These companies usually have a sustainable competitive advantage over their rivals that keeps them in the game, regardless of what their stock price may be doing from day to day. And it's this competitive edge that gives businesses a protective economic moat. Economic moat is something that helps a business remain financially competitive over the long term. We'll go into more detail about economic moats in the next modules. Even if negative events can cause a fundamentally strong company's stock price to dip, and here's an important thing, if that company can maintain its ability to continue operations as usual, it will rebound in time to a market price that is more in keeping with its true value. I want you to note that investors tend to have emotionally short memories. They won't remember what happened with the company in the past, and they only care about the present and the future. So as long as a company continues to demonstrate a consistently growing net income and cash flow, it's very likely to not only eventually regain its former glory after a price drop, but to become overvalued someday because investors start to recognize all over again what a great value it represents. And when looking for fundamentally strong businesses, some additional factors you should keep in mind are low debt and the presence of a strong and responsive management team. Overall, if a company has a history of performing well, you can predict that it will continue to do so over the long term. Once you've identified businesses that are fundamentally strong and that have a high intrinsic value, your next step is to add them to your watch list so you can buy them if and when they become undervalued. Under normal circumstances, stocks that are financially strong and that demonstrate promising future prospects are maybe too expensive to buy. For this reason, a fundamentally strong business doesn't always represent a good investment, because its stock value will have little potential to increase if you buy it when it's already trading at a price that's more or less in line with the company's intrinsic value. So in short, you need to learn how to find undervalued stocks so you don't end up buying them at the wrong time. But there's good news. A strong company can easily become temporarily undervalued for a number of reasons. These can include one-time events, such as internal scandals or negative news reports that cause disillusionment. But make sure that these events don't cause the company to lose its competitive edge or its ability to go about its business as usual. If you wait for such occurrences as a company failing to meet its projected earnings, a downturn in the economy, a significant change in a company's business environment, or similar types of bad news, you'll find many great opportunities to buy a great stock at a very low price. These events will likely cause a stock price to drop, and when this happens, chances are it will become undervalued or cheaper to buy. And as a value investor, you simply buy low and then sell high to make a profit. Now that you understand the best time to buy into a financially strong company is when its stock has become undervalued, you also need to know when to sell that stock in order to make a profit. Although we know that a high-quality company can be temporarily affected by negative market news that causes its stock price to plunge, we also know it's very likely to recover over the long term. And in the same way that bad news can cause a company's stock price to drop, good news can have the opposite effect and cause its price to surge during this recovery period. When a company publicly announces how well they did financially for the previous quarter, that makes investors feel excited, and they want to invest their money in that company. And when the demand increases, the stock price simply goes up. In either case, whether a business simply recovers its true value in time because of its intrinsic value, or becomes suddenly overvalued as the result of some positive event like share buyback, it will be the time to sell your stock and take your profit in the spirit of buying low and selling high. So I want to pay close attention to these events because they can help the stock price go up very quickly. And you'll also have to be quick to sell your stock and take the profit. Share buybacks and stock splits are common events that can lead to an increase in a company's stock price. Share buyback is a program by which a company buys back its own shares from the marketplace, usually because management thinks the shares are undervalued. And stock split happens when a company divides its existing shares into multiple shares to boost the liquidity of the shares. So as a value investor, we can take advantage of these golden opportunities to sell our stock at a temporarily high price and make a higher profit. And the stock price tends to go up during a bull market or economic upturns. And events like mergers and acquisitions can also lead to a significant movement in stocks. A merger is when two companies merge together. An acquisition is when one company buys out another company. So you need to pay attention to these events, especially the earnings announcement, because it happens almost every quarter, so we'll have at least 4 times a year to make big profits. In the next lecture, we'll talk about price and value, which is a very important topic in value investing. Okay, see you in the next video. Price is what you pay, value is what you get. Okay, now let's talk about price and value. Both price and value are the two sides of the same coin. Understanding the difference between price and value is important because it helps you sort out good investments from bad investments. So I want you to take a quick note here. Price and value are not always the same. You know, most inexperienced investors look at a stock's price to determine if it's cheap or expensive. They think that a $5 stock is cheaper than a $50 stock. Well, it seems cheaper because of the price tag. But they don't know that their $5 stock may be only worth $2 or $3, for example, while the $50 stock can be worth over $80 or maybe $100. So that's the difference between price and value. Looking at the price side is not investing. It's gambling, because you have no idea about how much your stock is actually worth. Only considering the market price is the same as you go shopping. You buy a product because the shop tells you that there's a promotion. They discount the product and you feel you're buying something cheap. But the thing is, even with a discount, that shop can still make a profit because they're selling you a product at a price that's higher than its cost of production. So that product is overvalued. The same for the stock market. As a value investor, we need to look at the value side. So before making your investment in a company, you need to make sure that you'll only buy it when it's undervalued. There are 3 types of value that you need to know about if you want to be successful as a value investor. Evaluating these values carefully will show you a clear picture of how profitable a potential investment is. The first is relative value. The second is absolute value. And the third is perceived value. Now, let's dive into each of them in turn. Relative value can be determined by comparing a company's financial performance with that of its competitors within the same industry, and also with the industry average. The differences between a company with its rivals tells you exactly how well it's operating and generating profits. When a company is profitable and able to operate efficiently, that will make a significant contribution to its shareholders' value. This simply means the more profitable the company is, the more profitable you are as a shareholder. So to determine relative value, the easiest method you can use is performing a financial ratio analysis. We'll simply compare a company's profitability, efficiency, liquidity, and solvency ratios with that of its competitors and the industry average. The company with the best ratio values will be the best company in the industry, and it's a worthwhile investment in terms of its relative value. Financial ratio analysis is a big topic in value investing, so I'll teach you how to use financial ratios the right way in another course. But right now, you just need to know that it exists, and you'll need to learn about it later to master your value investing skills. Okay, the second value that we're going to talk about is the absolute value. In short, it's the company's intrinsic or real value. You'll need to perform a stock valuation to estimate your company's intrinsic value. Then compare its value with the current market price. If the intrinsic value is higher than the current market price, or the company's stock is selling at a price which is cheaper than it's actually worth, this means it's undervalued or cheap to buy. So, we'll consider buying it to make a profit when the price increases in the future. And on the other hand, if the intrinsic value is lower than the current market price, the stock is overvalued or expensive. We simply avoid buying this company's stock. So to determine absolute value, we'll use some valuation methods, such as the discounted cash flow model or dividend discount model. Okay, the final one is the perceived value. Perceived value is the price that people are willing to pay for a product or service. And in the stock market game, it's the price that people are willing to pay for a share of a company. The perceived value is completely unrelated to the absolute value. The best example of perceived value is this picture. It's actually worth maybe just a few $100s to pay an artist to paint it. But guess what? It's worth millions of dollars. Why? Because there are people who are willing to pay that high price to own this picture. The selling price will totally depend on the perception of the buyers. And I want you to know this. The stock market also works on the perceived value, and the stock price of a company reflects the perception of investors like yourself. You can easily see perceived value in growth stocks, where companies are growing much faster than their competitors and the whole industry. So that's why investors are ready to take higher risks and pay a higher price for owning those stocks. And to determine the perceived value of a company, you'll need to do a qualitative research. You'll need to find out what people think about that company, how skillful and experienced its management is in growing their business, what the values are that the company brings to the world. And the only way to know this is spending a lot of time reading news, stock analyses, and customer reviews. In the next lecture, we'll talk about another important topic of value investing. That's the margin of safety, one of the most critical factors that will determine your value investing success. Okay, see you in the next video. In this video, we're going to talk about the margin of safety and how you can use it effectively to reduce risks on your investment and make a wiser investment decision. So what exactly is margin of safety? Margin of safety is simply the difference between the intrinsic value of a stock and its market price. For example, the market price of a stock is $6 a share. You find that its intrinsic value is about $10 a share. So in this case, we have a margin of safety of $4, or 40%. In fact, the higher the margin of safety, the lower the risk on your investments. The margin of safety is achieved when a stock is bought at a price which is sufficiently below underlying value to allow for human error, bad luck, or extreme volatility in a complex, unpredictable, and rapidly changing world. Or in other words, using a margin of safety will allow you to correct your mistakes in your investment analysis and valuation. Well, when it comes to stock valuation, we make mistakes all the time. Every valuation method is implemented based on assumptions. For example, when using the discounted cash flow model, you'll have to assume that a company's cash flow will grow at a consistent rate over the next 5 to 10 years. What will happen if its cash flow grows by 10% this year, 5% next year, and negative 8% in another year? You see, our valuation method is somewhat biased, and that's why the margin of safety concept is applied to value investing. So how much margin is acceptable? Well, it depends on how much bad luck you're willing to face, your risk tolerance, and how much money you can afford to lose. Losing some money is an inevitable part of investing. In fact, there's nothing you can do to prevent it. But to be a sensible and intelligent investor, you must take responsibility for ensuring that you never lose most or all of your money. If you think you can't afford to lose much from your stocks, it always pays to have a good margin of safety, say around 30 to 40%. This means that you must buy a $10 stock for not more than $6 or $7. Remember, the higher the margin of safety, the better. And also make sure that you will always use a margin of safety of at least 25% for the sake of your money's safety. In the next module, we'll dive into some investing principles that you should always keep in mind when investing in the stock market. Okay, see you in the next video. Hey guys, welcome to Module 2. In this module, we'll talk about some value investing principles. You don't have to be a legend to generate market-beating returns with a value investing strategy. But if you want to understand how to be a successful value investor, it will help to keep these principles in mind. Okay, the first point you need to acknowledge is that value investing is not gambling, and you should approach it with a full understanding of exactly what type of investor you are. And most importantly, you must understand exactly what you buy and why you buy it. Knowing the what and the why here is very important. Value investing isn't a passive strategy. Far from being a guessing game or a gamble, value investing is work. When evaluating a company, you should be able to answer the following questions and explain everything in your own words. What does the company you're investing in do? How does it make money? What are its competitors? What are the potential risks that it may take? And why do you expect its stock price to rise over time? It's important to know these things when you first invest, of course, but it's just as important to stay up to date on major developments affecting the company so that you can continue to answer those questions accurately. At a minimum, you should read the company's quarter reports and keep at least a half eye on news pertaining to the company so that you understand if its situation is changing. If something happens that lowers its intrinsic value, you'll need to reevaluate it. You still have a good reason to own the stock. If the company you own takes a turn for the worse, with no likely recovery on the horizon, selling its stock may be the best option, even if it means taking a loss. When it comes to investing, minimizing your risks is important, and that should be your first priority. So, that's principle number 1. Understand what you buy and why you buy it. See you in the next video. Okay, the second principle. Make sure you'll always invest in a cash-rich business. When a business is cash-rich, it means it always has abundant funds left over after paying all of its debts and expenses. It also means that its assets are liquid enough to be called upon should they be needed as an extra source of cash. So more cash simply means more liquidity. That's exactly what you'll want to look for as a value investor. And you should always make a point of investing in companies that have a strong cash position, because they're the ones most likely to pay regular dividends to their shareholders. At the same time, these companies are less likely to find themselves so strapped for cash that they are unable to service their debt loads when revenues dip or a recession hits. However, having a lot of cash is not always a good sign. You must find out if the management is utilizing their business cash well. Warren Buffett once said, "When people talk about cash being king, it's not king if it just sits there and never does anything." If the management can't utilize their business assets, it shows inefficiency in the company's operations, and that will be a red flag that you need to pay attention to. And finally, you'll want to look for cash-rich businesses with a long and uninterrupted history of dividend payments. When companies pay dividends on a consistent basis, they demonstrate stability and show a positive sign that after paying all expenses and debts, they still have a lot of cash left to pay dividends to you and other shareholders. And that helps increase shareholders' value, and in some way contributes to a growth in their stock's perceived value. Okay, that's principle number 2. Make sure you'll always invest in a cash-rich business. See you in the next video. Okay, besides looking for cash-rich companies, make sure you'll only invest your money in companies with a low level of debt. You're unlikely to find any well-established business that doesn't carry some level of financial liability. In fact, a little debt can be a good thing when it helps to provide the funding for business growth and expansion, since this type of activity tends to raise the overall value of a company. But that doesn't make it acceptable to invest in a business that's carrying a large debt load, since it's very easy for a company to get into trouble once it overextends itself financially and is no longer able to service or repay its loans. That is to say, having too much debt can lead to many financial troubles. So, as a value investor, you should be careful when picking a company to invest in. When looking at a company's financial statement, you'll find that there are 2 types of debt: short-term debts and long-term debts. For evaluating a company's short-term debts, you can use liquidity ratios. And for evaluating the long-term debts, you can use solvency ratios. To find out if a company's debt level is high or low, you can compare its debt ratios with that of its rivals and the industry average. And finally, you should also evaluate the company's ability to repay its short-term and long-term debts. If it can generate enough cash flow to pay its bills on time, there may not be any problem. However, if the company fails to pay its bills on time, it's going to have a problematic relationship with its suppliers and lenders, and that will affect the business in the long run. Remember that when you buy shares in any company, you are effectively lending that company your own hard-earned money. So make sure that you'll only seek out businesses with low debt loads and a reliable track record for repaying their debts. So that's principle number 3. See you in the next video. Okay, besides looking for low debt and cash-rich businesses, the next thing you'll want to consider is the quality of a company's management. In most cases, a company is only as successful as the people running it, and a big part of value investing is making sure that the business you buy into has a reliable, experienced, and forward-thinking management style behind it. One of the key factors in determining whether or not a business is on top of its game is to have a look at what gives it its competitive edge in the marketplace, and whether or not its management team has an ongoing plan in place for making the most of this competitive advantage. This means that management is not only acknowledging the competitive challenges that constantly threaten their company, but is adapting and responding to those challenges in a realistic and timely manner. To determine how well a company's management is doing in operating and expanding their business, you can use some efficiency ratios. And another great way to evaluate the quality of the management is looking at their company's competitive advantages. You need to make sure, to the best of your ability, that the people you are trusting your money with have proven themselves as effective decision makers and leaders within their industry. We'll dive deeper into how to identify a company's competitive advantages in the next module. Great companies should have great management teams. A great management team should focus on generating growth over time, which is the best way to reward long-term shareholders like yourself. So make sure you keep in mind principle number 4. Only look for companies that have both strong management and a sustained competitive advantages. And see you in the next video. Okay, let's talk about principle number 5. If you want to become a successful value investor, avoiding losses should be your first priority, even over generating investment gains. Remember rule number 1, never lose money. And rule number 2, never lose money. And I can tell you rule number 3 and number 4. Again, never lose money. Here's an interesting fact. It's simple math. If your portfolio's value drops by 20% and then grows by 20%, you've lost money. More to the point, in that situation, you need larger returns to meet your goals over time. That might lead you to take larger risks than you should, which could lead to more losses. As a value investor, you can minimize the risk of big losses by investing at a discount to a company's intrinsic value. And that's why you need to use the margin of safety as a part of your valuation process. While you may not always get market-beating growth, but if you can minimize losses and the need to recover from those losses, you'll need less growth to meet your investing goals over time. And besides giving yourself a high margin of safety, there are many ways you can go about minimizing losses on your investments. For example, you can easily avoid common costly mistakes like overtrading by only investing in companies that you're sure that you'll make a profit with. And before making any trade, you should always have an entry and exit strategy in mind. And don't forget to place a stop loss to protect your money. Okay, that's principle number 5. Never lose money. See you in the next video.